Greetings, comrades. Today we're going to look at a budgeted cash flow variance report. We've been asked to work out the dollar variance, a percentage to determine whether the variance is favourable or unfavourable, and we'll do a bit of evaluation of this month. An acknowledgement of the source. I pulled this exercise from Chapter 23, the Unit 1 VCE accounting book from Macmillan. The beauty of doing this in Excel is that we can basically do our calculations very efficiently by using the copy function. So the first thing we need to do is click in our variance column for the dollars for cash sales. That's our first variance. And whenever we want Excel to calculate anything, we always start with equals. Then we're going to click the actual sales figure for the month, 13,000. Which in my spreadsheet is cell C5. And then we want to subtract. So we're just going to hit minus, which should be at the top of your keyboard. And we're just going to minus the budgeted figure, which is cell B5. And if we look up here, it's actually got the formula in the bar up here. That's all we need for that calculation. So we just hit enter. Now, the beauty of using a formula for Excel is now we can copy that formula. So I've just clicked in that cell, Control C. I'm just going to drag all the way down in that D column. And if I paste Control V, it's worked out all the variances for me. Now, if we were doing this manually, then we'd do brackets for negative figures, etc. I'm not going to worry about that at this point. Next step is we want to convert this variance to a percentage. And again, the beauty of Excel is we can use a formula. So now we're in E column, the percentage column on my spreadsheet. Again, always start with equals. I'm going to click my $1,000 variance that I have in column D. And we want to divide that by the budget figure. So divide on the keyboard is backslash, which is towards the bottom of your keyboard. And then I'm just going to divide that by the budgeted figure, which in this case is 12,000 in column B. So again, look up the top here for our formula, equals D5, $1,000, divided by B5, $12,000, and we hit enter. Then we can copy that down, all the way down, and it's going to work out our percentage variances for all of our numbers. Okay. Now, my spreadsheet has automatically used percentages. If you end up with decimals, you'll need to go up the top here and you'll need to change your formatting. So either click on the drop-down bar to percentages, or you can simply work with that depending on your setup on your actual menu bar. Now, the next thing we need to do is identify whether the variances are favourable or unfavourable. So if we look at all the first three items in our operating section, they're all inflows. And what we're doing is working out if our actual figure was better or worse than our budgeted figure. Now, because these are inflows, if we receive more funds than we budgeted for, that's a good thing. So anything with a positive variance that's an inflow is going to be favourable. So we're going to get 2 Fs on our receipts from GST and our cash sales. Our collections from accounts receivable are significantly lower. That's unfavourable. We've received less from our credit customers. Then we get to these outflows. So these are all payments from our day-to-day activities. And now we've got to think in reverse. So for wages, for instance, we budgeted to spend $5,500. We've only coughed up $2,600. So we've probably reduced our hours for our part-time or casual staff, etc. So that's favourable in terms of the impact on our liquidity. Same with advertising. We've spent less than we forecasted. We'll just leave rent blank because we've probably got a fixed rate with our landlord. We've paid slightly more to our suppliers than we budgeted for, so that's negative in terms of the impact on our cash flow. Same with office expenses. We've spent more than we budgeted for, so that's unfavourable. Look, there would be a way to do this automatically with Excel, but I'm just going to basically work through this one by one so we can kind of approach this theoretically. GST payments higher than expected. So in terms of our net cash from operating activities, it's actually a favourable result. We've got a bigger surplus than we budgeted for, so therefore that is a favourable outcome. Purchase of computer, so that wasn't budgeted for, so therefore that is actually unfavourable in terms of the impact on our cash. Then we get down to our two financing outflows, and again, both of these, loan repayments and drawings, were higher than budgeted for, so they're both used as well, unfavourable. In terms of the net cash used, well, that's obviously an unfavourable. We've spent more than we budgeted for. And here's where it gets interesting down the bottom here. So if we look at the budgeted increase in our cash for the month, taking into account all three sections of our cash flow statement, we budgeted for a surplus and we've ended up with a pretty significant deficit. So that's highly unfavourable. No change in our bank balance at start because that's past tense. And so therefore we've got an unfavourable result in terms of our bank. Now, let's have a go at interpreting this and generating a report to management. I'm not going to type anything in. I'm just going to basically go with a verbal approach on this. So maybe put on the closed captions to unpack what I'm actually saying here. Always good to start at the bottom, I believe, because what we really want to hone in on is look what happened at the bottom in terms of our expected bank balance at the end was in surplus 2180, and we've ended up with a bank overdraft of 1200. Thanks, and so that's a 3400 discrepancy, highly unfavourable. So we start with that. We start broad by emphasising it's been a bad month cash-wise if we look at our final cash position. So then we go back to right here, our net increase, which factors in all three activities. We budgeted for a 680 surplus and we've ended up with a 2700 deficit. So therefore, again, that's the cause of the fact that we've gone from a surplus bank balance to a bank overdraft. So therefore, we want to look at our three sections. So let's go up to here, our operating activities. The operating activities, it's actually been a good result. We've actually, and because again, think about what operating activities is. This is the net cash flows from our day-to-day activities. So basically the bread and butter of our business. We budgeted for just short of a $2,500 surplus. We've ended up with $300 higher than that. That's a favourable result. If we want to scratch a bit deeper, if we look at our inflows, cash sales have been good. We've had a favourable result there, but our collections from accounts receivable are way down. So that means we've probably had less credit sales than we forecasted, or maybe we've had some credit sales at the end of the month that we just haven't collected yet. We'll receive those in December. Wages is much higher than expected. There's a 50% discrepancy there. Much lower. So therefore, we might have been a bit stingy with our part-time staff. But look at the advertising. We've only budgeted. We've budgeted 800. We've only spent 400. So this might come back to bite the business by literally halving our expenditure on advertising. Advertising is how we indirectly generate revenue by promoting our product. What's really impacted the cash flow of the business is our investing activities. So we didn't budget for a new computer, but we've had to cough up $3,000 for our computer. And so therefore, if we think about our $3,400 discrepancy down here, in our actual net decrease in cash held, it's largely attributed to this. So if we think about this in a real world context, obviously our computer's packed up. So therefore, we've probably been forced to upgrade, buy a new computer, and so therefore that's had an impact on our bank balance. It is an investment, but we're focusing here on the impact of cash. In terms of our financing activities, well, they're a little bit worse than we expected. So the loan repayment, maybe we're trying to accelerate reducing our principal because we haven't actually received any new loans. There's no new loans in our cash flow activities from financing. Drawings have been a bit high though, so therefore we need to basically tell the owner, look, we're in overdraft now, so we need to cut back on the owner's drawings if that's practical.